Check, check, check. Check, 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 check. Hey, it's working this time. Nice. Hey, we've got someone here. We have got someone here. Can you hear me this time? So, hey everybody. So let's take a look at some interesting stuff here. We of course have this pretty nice rally from earlier in the day that faded. I kind of thought maybe we would get up to that 9 EMA. That's kind of what I was targeting. If you look at here, let me see if I can share my screen. See if I can find the screen here. Let's go share screen. All right. Entire screen. Okay. So let's take a look at, we obviously have a market that's having a little bit of trouble here. Big reversals. Spotify is down 10 from its high. Microsoft has given up, I think, about $17 today. So those growth rallies are very short-lived, unfortunately. I've got my MTI indicator here, which is really telling you not to get involved. It's zero negatives from the volatility dampener. That basically says we are in a very high VIX environment, and that's going to keep us from getting too excited. Your IV rank on something like this, which really, if you look around, IV rank isn't all that helpful at this point because it's just telling you 100%. Like we're the highest levels of IV that we've seen in years in many things. Even look back to August, we're quite a bit higher than there in our implied volatility and our short-term implied volatility. And really the whole curve has been shifting up, right? So, and we saw that a few weeks ago. And I remember I noticed that. I mentioned it in the community and I said, what's interesting is that we've shifted up some of the farther expiries, right? So if we look at, I'm going to show you, that's trace. That's pretty cool. This is spot gamma. So let me show you the term structure. So when we you can see the term structure, that's basically implied volatility at the various expiries, right? So we can see it's downward sloping. This is in a state of alarm right now, right? Typically we want to see kind of low front month front month vol because people are relaxed, they're confident, they're not fearful. And as time goes on, they price out volatility higher and higher because over time, something's probably going to happen. So this is the opposite. This tail is wagging at the front and it's panicked, right? We can see very panicked at the part of the term structure in those near-term expiries. People are paying up big volatility. Now, implied volatility isn't as important in tomorrow's expiry or even a few days. But having said that, we can still see this sort of backwardation here, this kind of inversion. And so what I saw a few weeks ago is I mentioned, I said, not only is the front pushing up, those further out expiries are pushing up. And I said that's a sign that there's something durable going on, right? It's always easy to look back in hindsight, but usually you see the front part of the curve kind of flip up, and those further outs don't get excited until things get really, really ugly, or you have the influence of other things. So if there's credit vol problems, if there's something going on outside of equity markets, it will bleed into equity vol, VIX, etc. But we saw that back part of the curve. So the back part of volatility is telling us that there's something durable, something's going on that might take some time to sort out. We can see this skew here really kicking up again. It came down today a little bit. Here's your fixed strike. It was all red earlier in the day, which meant that they were pushing down fixed strike out of the money puts. They were pushing those down, which is a sign of a relaxation of implied volatility, a relaxation of fear to some extent. I pointed out many other things in my video earlier in the day that sort of showed that there was still quite a bit of fear out there. But now we're back positive again, right? So people are starting to push up fixed strike implied volatility, which is a sign, especially at a 50 VIX, that game on, right? And it should be. I mean, tomorrow's the big day, and unfortunately, we are still in the thick of things. So let's look at Trace. I dropped this into the I dropped this into the chat. We're having some data problems here. So I dropped this into the chat a little bit earlier. We can see the day, throughout the day, we had a nice pop there, 52.50, even a little bit higher. We got to 52.60. Very impressive rally after yesterday's kind of, beating in the morning. And then we basically just come down the whole day. We can see these red areas are negative gamma. So you start slicing through there rather quickly because there's not much support, right? Not to mention it's been just a terrible market. So data window that pops up here. But down here, we need to kind of hold a bit because there's some negative gamma in here. So we can see over on the left, you can see, I don't want to hover over it, but it's right here. You can see those negative bars going left. And that is dealer negative gamma, right? So that's where you have dealers, market makers, participants who need to hedge all the time, right? These are not clients. That's why these programs start to try to separate the client flow from professional flow. And not just client, meaning it could be an institution, could be JPM, it could be the caller, right? It's a massive position, but from JPM's perspective, they're not managing that position. They put it on and they don't worry about it for 3 months. But from the dealer's perspective, when they're short strikes from that JPM caller, for example, they need to manage that. They're managing things on a daily basis and throughout the day. So when they have negative gamma, that means if the market starts to accelerate to the downside, we can see the SPY right now, 491.90. If the market accelerates to the downside and it gets into this area, this is like kindling just about to catch fire. It's an accelerant that can keep pushing us. So that's why I'm saying we better kind of hold that 495 level, or we could go plunging down. And really that next spot of significant support is kind of right around the 4,800 level. And that's where you can see this whole nice pool of purple over here is positive gamma. So this is where, for example, a caller's put spread caller will be long and then short this one, which means the dealer's long it. So we should be able to see some support down around that 4,800 level. But that's pretty decent drop from yesterday's 52.60, from today's 52.60. It's pretty significant. But that might be the next spot where maybe we mount a little bit of a comeback from there. especially after tomorrow's events. So maybe we get a little bit of a knee-jerk reaction down to those levels tomorrow and then bounce up again. And we keep kind of bouncing around here until the market figures out what it wants to do. But there's no question there's still a lot of negative potential out there, because this is just really getting started. Any of the data we've been looking at has been backward looking. Any jobs, I mean, a little bit on the job side, maybe from Doge and things like that. But in terms of impact from tariffs and the grind to a halt that's creating in many respects, that has not come through in the data. So we don't have much to look forward to from a data and headline standpoint. We're just going to get, earnings season is going to start, and every CFO is just going to be mind blown, right? They're going to say, our mind is blown. We don't even know where to, they have no clue where to price things. They've probably stopped trying, they've probably pulled back on plans, on CapEx plans, on, like nobody really knows what's going on. So I think it's a very difficult situation for companies. It's a very difficult situation for analysts who have no clue where to price things, right? Where's the PE supposed to be? I don't know. Where's the E? Where's the E here? Are we going to go from high 280s on earnings, if this starts to get bad and stays bad, down to the low 200s? Well, then this market's still expensive. So there's a lot to grapple with here. I don't want to be too negative, because I want stocks to go up as well. But the reality of it is, this is no longer the market we've known for a couple of years. This is now one that is being injured fairly aggressively and intentionally, which is kind of the silliest part of it all. So this morning I was looking to do some credit spreads. So I think what you can be doing is, on these rallies, which is what I did a show yesterday, and I was kind of talking about, look at that SPY, up to almost yesterday's highs after the fake news, and then all the way back down. So I think what you can do is you can kind of pick your spots, and there are a few different trades you can do. So if we rally to a spot that you like, and for me, a spot would be kind of close to, like, if I pop in, I think you want to be patient. But if I pop in a chart of SPY here, daily. So we almost got there. I was kind of looking for this 9 EMA to hit. At the time, it was maybe a little bit higher. So I was looking to sort of get there. I probably shouldn't have waited. But as you get close to that, in a bearish market, that 9 EMA is often kind of that first target, usually a good target, but we can sometimes push through as well towards the 20. So I was figuring between the 9 and the 20 is going to be your area to basically fade this kind of almost like a shelf of activity here, where there's probably a lot of stock for sale. And that's, maybe they kind of started to sell early, sell often. So this is going to be a tricky spot to get through. And that's where you can kind of go in and say, you know what, I'll go in and maybe sell like go into May and target. If you don't want to be too aggressive, if you want to be aggressive, you can go for like a 40 delta. That's very aggressive. You definitely want to feel like we're going to pull back. But I think a safer play could be selling a 30 delta. So you sell something like a 30 delta May, which would be a 529, and then pick up a 539. And what are you getting for that? 990 and 690, basically, right? So you've got $3 for a $10 spread. And if the market does rally, you are, here, I'll plug it in for you. You've got a couple things going for you, which is your short Vega, right? So your short Vega, so So if you look at the P&L, this thing's going to pop up. I mean, mathematically, you know what it is, right? We're getting into the weeds with the Greeks, but you know what it is. You're basically trying to collect $3. Your downside is the rest of the full value of the spread. It's a $10 spread, so the rest, so you have $7 of downside. So $3 to potentially lose 7. Now you can get in the way, and if it goes against you by, if it's worth, $6 at some point, then you kind of cover it. Or $5. I guess if it gets to about $5 is probably, where I'd probably cover it if you wanted to. But if you're really long in your portfolio, you can kind of let this thing go, right? It's a little sort of way to kind of scalp a little bit of high vol. Now, what's going to happen is if we do rally up into those levels, you probably see a little bit of a compression of volatility. So that's where your veg is going to come in handy, right? So if the VIX goes from 50 down to 32, you're going to make a little bit of money on that Vega crush. So you have a little bit of, you've got a little bit of insulation. It kind of works this way in an iron condor a little bit when you've got the downside put spread and you've got the upside vertical, the credit spread as well. So that's what this is. This is the upside credit spread, basically. And as you never get hurt quite as quickly as you think, because that upside volatility gets crushed a little bit. Unless they hang it in there, right? Unless they and we've certainly seen some of that in the last 6 or 8 months, where we've seen spot up, vol steady, or spot up, vol up even. Because if moves get very violent, then the VIX doesn't want to come down as much. Now it'll come down off of 50, that's for sure. But so generally speaking, you have a little bit of short Vega that's going to help to correct a little bit. So it might give you a little bit more breathing room as you sort of look at this sort of consolidation shelf area. So that'll give you maybe some ability to kind of hang in there and wait for it maybe to finally turn down again. Now, what you can also do is you could sell this and you get your $3, and you could take that and pick up some downside. Oh, we've got the SPY at 490 now. So really, what a reversal today. 350 points. I mean, we have got some serious ranges. The VIX is fairly well justified. I mean, it's pricing in at 50. It's pricing in, what is that, about a little bit over 3% a day. That's 3% moves per day, every day for the next 30 days. Now, 3% every day for 30 days is probably not going to happen. But right now, it's happening. We're getting very, very big moves. So as long as we get these moves, the VIX is going to be pretty happy to stay where it is. So what you could do is you could take that $3 and you could kind of pick up some downside, maybe buy like well, now we're down at 490. So you could pick up maybe like a 474, and that'll cost you about 2083. And you could sell the 453. So, you pick up a 483 and you could sell maybe a 453. So you're getting a pretty nice spread there, a pretty nice downside spread there for a few bucks. And you financed it with the $3 that you've collected off of your bear call spread. Right? So it's a nice way to kind of finance what is really expensive downside right now. The downside is just expensive, right? So one of the big challenges, even in the best of times, market insurance is expensive, right? It's never that cheap. It's not like house insurance, relatively cheap. But market insurance is usually expensive. So the nice thing about this is kind of like a collar, but just using sort of a limited risk upside to finance. The nice thing about that is it's vol agnostic, right? So no matter what kind of market you're in, a collar can be kind of nice and not punitively expensive because you're using expensive vol to buy expensive vol. Now, the skew plays into it as well, right? That downside skew is expensive. So I'm not saying it's, kind of an even trade-off. You're probably giving up a decent amount of vol edge here. You're paying for very, very steep downside. Lately, downside has been extremely steep, and you're financing it with like okay upside. Like it's not going to be super expensive. So callers usually never work from that perspective. They're never like a screaming positive volatility edge kind of trade, but it is what it is. If you're long stocks and you need to protect some of the downside, it is what it is. And at least it sort of does some of the job in paying for some of that downside. So you can either use that credit spread to generate a little bit of cash. You can use it to buy a little bit of downside. And as some of you who know me know that in this kind of environment, I like to have that downside, right? I don't think you're really getting paid very much in general. I don't think you're getting paid enough on the downside for selling put spreads or puts. And I don't think you're really getting paid very much, obviously, on the upside, because we could get these face rippers. So this is a market where there's a lot of movement. Realized volatility is very high, clearly. And things are in motion. I mean, look at this. This is another nice visual that you can have, which is market chameleon. So look at this downside put skew in SPY, higher than last August. Last August looked insane after it happened. And here we are with significant parabolic put skew, basically. You can go by delta. It doesn't even look as bad here, but it's pushing up today. You can see that. So this is your fixed strike really kind of pushing up a little bit. Now, what normally happens is folks, let me see here. What normally happens is markets kind of, when the market comes down, it rides down that skew curve. So this is just sort of a little bit of info for you guys. Like if the market goes down, it's riding up the skew curve on SPY, on the implied volatility, right? So sometimes when the market goes down, we see the VIX go up and we think, well, people are buying insurance. They might be, but they're not aggressively buying it necessarily. We know when they're aggressively buying it because that's when fixed strike goes up, when the curve is shifting. That gives you extra information, right? So when you see this, you know that there's a sense of urgency in protecting yourself. People are paying up for those strikes. So they're kind of like, the market's riding down this, but it's also shifting, right? This curve is shifting up. It's kind of like saying, it's kind of like, where do I have this? Go like this. So here's your skew. And normally, as the market kind of goes from here to here, those out of the money puts are more expensive, right? So the market's just it's riding up that implied volatility slope. It's a slope. And so the VIX is rising. But as soon as things get a little bit uglier, then you get a shift up in the curve, right? See, the whole curve has shifted. And that is a more durable sense that something's going on. So let's take a look. We've got about 6 minutes left in this market day. What have we got? Oh, we got a little bounce here. That's good. That's good. We got a little bounce off of the 490 level. Looks like we've got just under 490, 495.73 right now. What a candle. What a candle. Not quite the same as yesterday. Yesterday was even more extreme because we got almost down to 480. But if you're nervous about this market, if we get back up into this kind of, and I can see it happening, why not? We could get back up around 520, 525. That's an area where, if you are worried and you want some sleep at night protection, you could jump into a June, July type caller position. And you could sell right now, we're 495. So assume we're back at 520. You could probably get 22 bucks for the 545. So you could get about 25 bucks for the 545, and you could use that to finance some downside. And if the market has a massive rally, then so be it. You just kind of accept that, and you move, you reassess at some point. No, there's nothing that says you can't, roll up that upside structure a little bit. So that is really where we're at. I'm going to take a look at let's take a quick look at, here's our XLP to SPY. So I like to look at these relationships just to see where there's outperformance. You can see staples, since growth kind of started to fall apart here, we can see the staples really outperforming the SPY. They pulled back. I mentioned this in a couple places, pulled back to that lower Bollinger Band, and then bounced right back up here. Now, I thought that the staples kind of had run out of steam here. Clearly not. They kept going. So we're poking hugely through the Bollinger Band. Typically, when that happens, eventually it fills back in. So a reasonable argument for this to probably start filling in, and maybe just a little bit of roll back into growth momentum, at least temporarily. But my thoughts lately have been, start looking at, like, we get a nice rally because everything's been ugly, but then maybe you want to start positioning in low vol type stocks. So if look up SPLV, which is like a low vol index, a low vol ETF, and you've got all kinds of good things in there that can potentially do okay in a downturn, right? I mean, everything kind of can correlate to one if it's really ugly, but over time, the Walmarts, the McDonald's, the Colgate-Palmolives should do okay. I think Costco should do okay, even though it's extremely expensive. I think it'll continue to command a premium. So there's, SPLV is a good place to look. I put out a video a couple months ago on that, so check that out. Go into my channel and see if you can find that. And I show you how to scan for those good stocks in that space. And those might be interesting places to be, right? Because everyone's always looking for the same stuff, right? They want to play the bounce in AMD. They want to play the bounce in NVIDIA. And I just don't know if it's time. I mean, we had a bounce today, right? NVIDIA got to 105, but here it is back at 96. So it's just not, that was a good spot, right there. Boom, broke down, retested, right back down again. I mean, I feel like it could probably get into the 70s, maybe 75 to 80. Just hard to say, right? When the bloom is off of something, it's hard to say, right? One thing you have to understand is that when things are really great, we overshoot to the upside. We overshoot. Multiples don't matter as much because everything's great. But when things are bad, it's the flip side of that. Things can overshoot to the downside. So if you think NVIDIA should be worth 85 bucks, probably going to go to 75, right? So things overshoot because people just get dejected, and eventually they just start, tossing everything out that worked before. And so I don't know. Does it stabilize? If you have to own one semiconductor, it's probably that one. It's not massively expensive, PE wise. Price to sales still a little bit on the expensive side. So there's some challenges there still for growth, for AI. Microsoft has given up a pretty good chunk of its rally today, got around 973. back to 355. So pretty much $20, more than a $20 sell-off. So these ranges are getting wider, not more narrow in a sense. And so I think until things start to calm down a little bit more, I think it's a difficult market to be a seller in, like an option seller. You're getting high levels of implied volatility. So, you know, if it's names that you kind of really are comfortable with and you don't mind owning, then okay, it's probably hasn't been as good a time in a long time, right? If I go into something like Microsoft and I've been waiting, this thing traded up to 450, and I've been waiting to own this thing, you know, at 350, I can get 23 bucks for that put right now. That's some pretty decent juice. I mean, with the market moving around 6-7% a day, it doesn't seem like it seems like it could even be better, but it's pretty big for something like Microsoft, right? You can see it trading 47 implied vol, where typically you're probably in the 20s. Now, one thing I like to look for is I'd like to look for a pullback in historical volatility, right? So let me go. Everyone focuses on implied volatility, and of course it's important. That's your pricing right there. So let's go. There we go. So I like to watch historical volatility as well, because implied volatility is pricing and it's opinion. It's a educated sense of where things are going to be. The market's always trying to estimate where volatility can be, but reality is historical volatility. There's a million studies that use implied volatility. Why not historical volatility? That's your reality, right? That's what the market's doing. It's moving, at least recently, at the historical vol. So this is your reality, and that's why the two are related, of course, because implied should be related to historical. But historical is really kind of your in a sense your better indicator of when things start to calm down, because when historical calms down, then implied should calm down as well. Now, sometimes implied will lead historical down. But as you can see right now, historical volatility rank on Microsoft is at 56. So this is anytime we get above 50, I tend to be using more protective type strategies. And if we get down into sort of the 40s and 30s and 20s again, then that's where you can probably get into just cash secured puts again. So you want to always have a kind of sense of the environment that you're in and have that inform your strategies, the sort of level of aggression, the level of, you know, how much you're putting yourself out there from a risk standpoint. In this market, we've been at an elevated vol for a while. And if you were selling cash secured puts left, right, and center at 5,500, you've been annihilated, right? And already the risk gauges were very, very high. We have one in the trading room that a member just literally said a few minutes ago, 45 minutes ago, he said, great indicator. It's kept me on the right side of things. So you want to have these risk gauges. And if you don't have fancy ones, like we have pretty complex ones, you can just use the VIX. You can use VIX futures. That's one of the absolute best tools, to be perfectly honest with you, is using the VIX curve. As soon as it backwardates, meaning that front month higher than the next one, that's your flashing neon sign that says, take it easy, be careful, don't necessarily trust the rallies. And that's fine.